Most people assume building wealth requires intelligence, constant effort, and perfect timing. But over the last century, the investors who ended up richest were often the people who paid the least attention. Not because they were lucky, because they stopped interfering. I want to tell you about two people. Same age, same salary, same city, same everything. The first one is John. John is the guy who's always on top of the market. He checks his investing apps every morning before he even gets out of bed. He's got accounts on 3 different platforms. He reads stock tip newsletters. He buys into whatever's trending on Reddit. When the market dropped hard in 2020, John panicked and sold everything. When everyone was going crazy over meme stocks, John was right in the middle of it. He spends hours every weekend rebalancing his portfolio. He feels like he's working really hard at building wealth.
Over 25 years, John watches financial news during his lunch break, listens to investing podcasts on his commute, and personally executes thousands of trades. He is constantly doing something. Now, meet Mary. One Sunday afternoon, while making herself a cup of tea, Mary opens a brokerage account for the first time. She puts $10,000 into a single index fund. She sets up a small automatic monthly transfer, $100 a month. And then she closes the app. That's it. She doesn't check the news. She doesn't watch what the market is doing. When her coworker is panicking about a crash, Mary is at her daughter's school play. When her brother won't stop talking about some hot new crypto at Christmas dinner, Mary just smiles, pours herself more wine, and changes the subject.
Her investing app lives in a forgotten folder on the 3rd screen of her phone. She opens it maybe twice a year. Fast forward 40 years, they finally sit down and compare what they've got. Mary has around $400,000 from one Sunday afternoon and a small monthly habit she barely noticed. John has a fraction of that, plus years of stress, thousands of trades, and a mountain of regret. He worked harder. She ended up further ahead. And here's what's wild. The math predicted this the entire time. There was never any mystery here. The outcome was always going to be exactly this. Today, I'm going to show you exactly how this works, why doing less wins in investing, and the specific steps you can take right now to set up your own version of what Mary did. Let's start with the engine that makes all of this possible, because once you actually understand it, everything else makes sense. It's called compound interest, and it's basically the only force in personal finance that gets more powerful the longer you leave it alone. Here's the simple version. Your money earns a return. Then that return earns a return on top of itself. Then that earns a return. And it just keeps multiplying year after year, whether you're watching it or not. The S&P 500, which tracks the 500 largest publicly listed companies in the U.S., has returned an average of around 10% per year over the last century. Adjusted for inflation, that's closer to 7%. Either way, it's the number most financial planners use as their baseline. So what actually happens to $10,000 left in an index fund tracking that return? After 10 years, $25,900. You literally did nothing, and your money grew by over $15,000. After 20 years, $67,300. After 30 years, $174,500. 39 years, over $400,000. From one decision. No extra contributions, no trading, no watching the news. The money just sat there and compounded.
There's a shortcut for understanding this, called the Rule of 72. Take 72 and divide it by your annual return, and that tells you how many years it takes for your money to double. At 10%, your money doubles roughly every 7 years. So $10,000 becomes $20,000, then $40,000, then $80,000, then $160,000, then $320,000. By year 42, you've crossed $640,000. Here's the part people don't expect. Each doubling adds more money in absolute terms than everything that came before it combined. The first doubling adds $10,000. The fifth doubling adds $160,000. That's what people mean when they say compounding is exponential, not linear. The first 10 years honestly feel slow. You put in $10,000, watch it creep upward, and wonder if any of this is real. The last 10 years feel almost unfair. The chart turns into a vertical wall, and you didn't do anything differently. You just stayed in your seat. Now here's what happens when you add even a small monthly contribution on top of that initial investment. $100 a month, which is roughly the cost of a couple of nice dinners out, invested consistently over 39 years at that same 10% return, adds another $600,000 on top of the $400,000 from your initial deposit. You're looking at over $1 million total. Bump it to $200 a month and you're past $1.5 million. $500 a month and you're well over $3 million. None of that requires a finance degree, a stockbroker, or hours of research. It requires one setup and the discipline to leave it alone. So if the math is this clean and well documented, why doesn't everybody do it? According to Federal Reserve data, the median retirement account balance for Americans approaching retirement age is around $71,000. Not $400,000, not $1 million. $71,000. That's the middle person. The average is higher, but that's being pulled up by a small minority who actually followed through. The answer to why comes in two parts. First, most people never actually understand what an index fund is, so they never use one. Their money sits in a savings account, earning a fraction of what compounding could produce. Or they pick individual stocks based on headlines. Or they pay an advisor who charges them for a complicated strategy that quietly underperforms a simple index. Second, the people who do start investing in index funds get scared out at exactly the wrong moments. They sell during downturns. They stop their automatic contributions when things get tight. They borrow from their retirement accounts for a home renovation. We're going to fix both of those. Let's start with what an index fund actually is. An index fund is basically a basket. Instead of trying to pick the next big winner, you buy one fund that holds small pieces of hundreds or thousands of companies all at once. The Vanguard Total Stock Market ETF, ticker VTI, holds shares in over 3,000 U.S. companies. The Vanguard S&P 500 ETF, ticker VOO, holds the largest 500. Fidelity has a version called FZROX that does essentially the same thing. When Apple goes up, your fund goes up. When some small company collapses to zero, your fund barely notices because it was a tiny sliver of the basket. You own the whole market, so you can't lose to the market. Now here's the part that should settle this debate permanently. A group called S&P Dow Jones Indices publishes a report every year called SPIVA, S&P indices versus active. They track how professional fund managers perform compared to a basic index fund. Their most recent 20-year data shows that over 94% of active fund managers underperformed the simple index.
These are professionals, Bloomberg terminals, teams of analysts, Ivy League degrees. They charge their clients up to 1% per year to manage their money. And 9 out of 10 of them lose to a fund that just buys everything and never trades. Warren Buffett, widely considered the greatest investor of his generation, actually bet $1 million on this in 2007. He wagered that a basic Vanguard S&P 500 index fund would beat any basket of 5 hedge funds over 10 years. A hedge fund firm took the bet. 10 years later, the index fund had returned over 125%. The hedge funds returned around 36%. Buffett won. He gave the winnings to charity. And in his letter to shareholders, he said what he always says: just buy the low-cost index fund and stop looking for shortcuts. He went further than that. In his own estate planning, he instructed his trustees to put 90% of the money he leaves his wife into a single low-cost S&P 500 index fund. The greatest investor alive trusts the index over everything else.
2 reasons. Both come back to keeping things simple. The first is fees. Active funds typically charge between 0.5% and 1.5% of your balance every single year, whether they made money for you or not. Index funds charge close to nothing. The Vanguard Total Stock Market Fund charges 0.03%. Fidelity has a fund called FZROX with a 0% expense ratio. 0. That gap looks tiny on paper. It's devastating over time. Take $10,000 and grow it for 40 years at 10% inside an index fund at 0.03% in fees. You end up with around $447,000. Take the exact same $10,000 at 10% inside an active fund charging 1% per year. You end up with $314,000. Same starting amount, same market, same time horizon. The 1% difference in fees cost you $133,000. That's 13 times your original investment, gone to fees, for a fund that statistically underperformed the index anyway. The second reason is human behavior. Active fund managers have to do something. That's what their clients pay them for. So they trade. They move in and out of positions. They try to time the market. And here's the brutal truth about market timing. Missing just the 10 best days of the market over a 30-year period can cut your final balance roughly in half. Those best 10 days are impossible to predict in advance, and they often happen right in the middle of the scariest moments. An index fund can't panic. It can't read scary headlines and react emotionally. It just keeps owning everything, and the compounding grinds forward. Buying the right fund is only half the story. You also need to buy it inside the right account, because the account you choose can save you or cost you tens of thousands of dollars in taxes. Here's the simple order of operations. Start with your employer's 401k, but only up to the employer match. If your company matches up to 4% of your salary, you put in at least 4%. That match is a 100% instant return on your money. Nothing else in personal finance comes close. Skipping it is like walking past free money every single day. Next is the Roth IRA. This is most financial planners' favorite account in America. You contribute money you've already paid taxes on,
It grows completely tax-free, and when you withdraw in retirement, you pay nothing. The 2026 contribution limit is $7,500 per year, or $8,600 if you're 50 or older.
There are income limits. For single filers, the full contribution is available up to $153,000 in income, with the phase-out running to $168,000. For married couples filing jointly, it's up to $242,000, with the phase-out to $252,000. If you're above those limits, look into something called the backdoor Roth IRA. It's a legal workaround worth knowing about. Third is the Health Savings Account, or HSA, if you're on a high-deductible health plan. This one is massively underrated. It's the only account in America with 3 layers of tax benefits. Your contributions go in pre-tax, your investments grow tax-free, and withdrawals for medical expenses are also tax-free. After age 65, you can use the money for anything at all. For 2026, the limit is $4,400 for individuals and $8,750 for families. Most people treat their HSA like a checking account for medical bills. That's the wrong move. The smart play is to invest it in an index fund inside the account. Pay your medical bills out of pocket if you can, and let that account compound for decades. Once those 3 accounts are maxed, anything left over goes into a regular taxable brokerage account. Just a normal account at Fidelity, Vanguard, or Schwab, with no contribution limits. That's the entire framework. There's no step 6. Now, here's the part that actually separates people who build wealth from people who just plan to. Automation. Every major brokerage, Fidelity, Vanguard, Schwab, lets you set up an automatic monthly transfer from your checking account directly into your chosen fund. You pick the date and the amount once, and it happens every month without you thinking about it. Whether the market is up, whether the market is down, whether you're busy, whether you're broke, the transfer happens. This is called dollar cost averaging, and it has one massive psychological advantage. It takes the decision away from you. You will never have to wonder whether today is a good day to invest. Past you already decided. Present you doesn't get a vote. When prices drop, your transfer buys more shares for the same dollar amount. When prices rise, it buys fewer. Over decades, you accumulate a low average cost without ever timing anything. You're automatically buying more when the market is on sale, which is the exact opposite of what most emotional investors do. The S&P 500 has crashed hard multiple times. The dot-com crash wiped out nearly half its value between 2000 and 2002. The 2008 financial crisis saw a 56% drop. COVID crashed it 34% in 5 weeks. Every single time, the news said it was the end. Every single time, the investors who automated and ignored the noise came out ahead. The S&P 500 hit a low of 676 points in March 2009 at the bottom of the financial crisis. As of early 2026, it's trading above 7,000. That's a 10x return in 17 years for anyone who simply did nothing. Research from Vanguard found that investors who avoid emotional reactions during downturns earn roughly 1.5% more per year than those who don't. Compound that over 40 years. That's the difference between $400,000 and over $700,000, just from staying calm. Charles Schwab looked at their internal data and found that the accounts with the best long-term returns fell into 2 categories: people who had forgotten they had an account, and people who had passed away and the account hadn't been touched. Doing nothing literally beat doing something. For most people, you really only need to know 2 options. Option 1, target date fund. You pick the year you plan to retire, find the matching fund, and buy it. If you're 30 now and plan to retire around 65, you'd buy a 2055 or 2060 fund. The fund automatically holds a mix of U.S. stocks, international stocks, and bonds, and it gradually shifts towards safety as you get closer to retirement. You do nothing. Ever. Look for Vanguard's Target Retirement Series, Fidelity Freedom Index Funds, or Schwab Target Index Funds. Make sure it has the word index in the name. The actively managed versions cost more and underperform. Option 2, a 3-fund portfolio. You buy 3 things: a U.S. total stock market fund like VTI or FZRAX, an international stock fund like VXUS or FZILX, and a U.S. bond fund like BND. You decide on a split, something like 70% U.S. stocks, 20% international, 10% bonds if you're younger, and once a year you rebalance back to those percentages. That's your entire investing strategy. Pick one. Either works. Both outperform the vast majority of more complicated approaches over time. The actual steps. Go to fidelity.com, vanguard.com, or schwab.com. Open a Roth IRA. It takes about 10 minutes. You'll need your social security number and bank account info. Transfer money in. Go to the trade screen, type in the fund ticker, hit buy. Set up the automatic monthly transfer. Move the app to a folder you never open. That's the whole thing.
I want to be straight with you about one thing before I wrap this up. The strategy I just described is simple, but simple doesn't mean easy. The reason most people don't pull this off isn't ignorance. It's that the money that's supposed to go into the index fund keeps getting absorbed by other things first. The $650 car payment that everyone around you treats as normal. The mortgage payment that takes up half your take-home. The lifestyle creep where every raise quietly disappears into nicer habits. The credit card balances that snowball slowly. The home renovation that doubled in cost. The investment that looked like a sure thing and wasn't. Each of these looks like a reasonable adult decision in the moment. Together, they quietly siphon off the money that was supposed to go into the compounding machine. The math in this video works perfectly. The accounts are available to anyone. The fees are essentially zero. The strategy is proven over 100 years of market data. The only thing that can break it is the slow drain of money into traps that never get audited. And the emotion that convinces you to sell when things look scary. Plug those leaks. Set up the automation. Leave it alone. That's it. That's the whole thing. Mary didn't do anything special. She just didn't interrupt the math. If this video clicked for you, hit subscribe to Flowcraft Invest. Every week, I break down one money concept in plain language. No jargon, no hype, just what actually moves the needle over time. And if you want to go deeper on the specific traps I mentioned, the car, the mortgage, the lifestyle creep, I've got a full video on that right here. It's worth watching before you do anything else, because the investing strategy is the easy part. Making sure the money actually makes it to the account is the work. I'll see you in the next one.